Major US equity indices are still in all-time high territory, but momentum appears very stretched and a pause for breath or even a minor correction is looking very likely. And this is common to breakouts, where a pullback to previous resistance, now support of course, sets the stage for the next move. And as long as 6150 holds for the S&P, the breakout remains valid. Now, aside from a short-term momentum that is stretched, breadth also appears to be retreating. The number of S&P stocks above their 50-day moving average has come back down to 59% from over 75% at the start of the month. And about half of the index stocks have an ADX below 20, a sign of hibernation before the next move. And similarly, some 45% of S&P stocks have an RSI reading, a measure of momentum, below 50. In absolute terms, all sector indices are showing this fatigue, and on a relative basis, the one to watch is the communication sector, and read Google and Meta, which has been stuck in a narrow 3% relative range for the past 4 months. And on the same relative basis, tech remains the outstanding outperformer. But with participation fading, will this outperformance hold? And importantly, European markets have now pretty much unwound all of their outperformance since the start of the year. Well, so much for the end of US exceptionalism. While earnings over the next few weeks, especially with tech reporting, will determine whether we see more legs post the breakout or an extended pause, we would reiterate that the uptrend is still in place and not yet negated. Growth sectors, fatigued as they may be, remain the preferred plays, at least until we see specific signs of change. Like, subscribe, and share. This is Sunil Garg from Lighthouse Canton.